If I could go back to when I first started investing, I would avoid so many mistakes. I lost money, chased hype, and honestly had no idea what I was doing. In this video, I'm going to break down what I wish I knew before investing in the stock market, so you don't make the same mistakes. What's up, guys? Welcome to KTV Finance, where we talk about money, investing, and building real wealth. If you're a beginner, this video might save you thousands of dollars and years of frustration. Let's get into it. The first thing I wish I understood is this. The stock market is not gambling, unless you treat it like gambling. When I started, I was buying random stocks I saw online, hoping they would go up fast. That's not investing. That's guessing. Real investing is about buying solid companies or funds and holding them over time. Think long-term, not quick money. Another big mistake I made early on was chasing hype. If a stock was trending on social media, I felt like I had to jump in before it was too late. But by the time most people hear about it, it's already too late. Smart investors don't chase hype. They focus on value and long-term growth. The next thing is you don't need to pick individual stocks to make money. Most beginners are better off investing in index funds like the S&P 500. Instead of betting on one company, you're investing in hundreds of top companies at once. It's simple, safer, and proven over time. Another big lesson: time in the market is more important than timing the market. I used to think I had to wait for the perfect time to invest. That was a mistake. No one can consistently predict the market. There will always be news, fear, or uncertainty. If you wait for the perfect moment, you might never start. What actually works is getting in early and staying invested. Even small amounts invested consistently can grow a lot over time. Another mistake I made was letting emotions control my decisions. When the market dropped, I panicked and sold. When the market went up, I got greedy and bought too late. This cycle destroys a lot of beginners. You have to stay calm and stick to your plan. The market going up and down is normal. Volatility is part of investing. One thing that helped me a lot later on was understanding risk. Not all investments are equal. Some are stable and grow slowly. Others are very risky and can swing up or down fast. As a beginner, you don't need to take huge risks to build wealth. In fact, keeping things simple and consistent usually works better. I also didn't realize how important diversification was. Putting all your money into one stock is risky. If that one company fails, you lose a lot. But when you spread your money across different companies or funds, you reduce your risk. Another thing I wish I knew earlier is the impact of fees. Some platforms and funds charge fees that slowly eat into your returns over time. It might seem small, but over years, it adds up. Always pay attention to where your money is going. I also wish I started earlier. Even if it's just $50 or $100 a week, it adds up because of compound growth. Your money starts making money, and then that money makes more money. The earlier you start, the more powerful compounding becomes. Time is your biggest advantage. And here's something most people don't talk about enough. Discipline matters more than knowledge. You can watch all the investing videos in the world, but if you don't stay consistent, it won't matter. Building wealth isn't about being smart one time. It's about doing the right things over and over again. At the end of the day, consistency beats everything. You don't need to be perfect. You don't need to find the next big stock. You just need to invest regularly, stay patient, and think long-term. That's how real wealth is built. If you're just starting your investing journey, keep it simple. Focus on long-term growth, invest consistently, and don't let emotions control your decisions. If you found this helpful, subscribe to KTV Finance for more videos on investing, passive income, and building wealth. See you in the next video.